Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50 year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
One of the things we're going to talk about today is the top 10 myths when it comes to real estate investing. And what a lot of people don't know is there's probably something in the background or something that you heard about real estate that may be holding you back from jumping in and getting started. I know there was for me before I actually got in. I overthought way too much. And the thing is, we tend to complicate things in our mind as opposed to simplify them when we don't know or haven't done it before. For example, if you think about, learning how to ride a bike. If you were to teach a little kid, you would be telling them, hey, there's going to be a bunch of scrapes and bruises. Or if you were to ask a little kid, they would think, man, how do you balance? There's going to be a bunch of scrapes and bruises. You're going to, have to wear this helmet because you might hit your head and all these things. Whereas as a grown adult that knows how to ride a bike, you just jump on and you ride. You just keep moving. The faster you go, the better, right? And you kind of know how to turn and lean your body. But that'd be very hard to explain to somebody that was trying to learn for the first time. Similar thing with real estate investing. And one thing that I believe is that everybody, and I do mean everybody, should own real estate. When you look at what's happening in the industry and just across the world with this AI boom, there's not many safe havens that you can go to. But one thing that I'm pretty sure is still going to be around is people needing to lay their head down somewhere at night. Whether AI is here or not, people are still going to need a place to go and live, and real estate is that place. If you run your numbers right, if you buy the right properties, you will be successful. This is something that's been around since just about the beginning of time. And so we're going to dive right into the top 10 myths about real estate investing, with the first one being you need a lot of money to get started. This is a myth. I actually got started buying a triplex in Louisville, Kentucky with $5,000. That was all I had to my name, right? Because there's different loan programs that you can utilize, such as the FHA program, or even, like a VA program or down payment assistance programs that will help you cover the majority of your cost if you're going to be living in that property as well. And that's what I highly recommend for a new investor, but it probably costs less than you think to get into a property. I've even heard from other people when they say like, hey, you're going to have to put down, 20 or 25% on a multi-unit. And that's not true either. Now we have DSCR loans where they look at the property itself, and you may be able to put down as little as 15% on a multifamily property as well and still be able to kind of make that happen. And so there are many ways to get it going. You do not have to have hundreds of thousands of dollars to get started in real estate investing, and you do not have to buy it cash. The cool thing about real estate is you're able to leverage and use those funds from the bank to build your portfolio. Myth number 2, you need a 20% down payment. This goes back to what we were talking about before. 20% is if you're buying it as a pure investment. But even if you're doing that, if you're going to buy, say, a short-term rental that's out of town, maybe it's 50 miles or more away from where you live, you can put down as little as 10%, right? And so that changes the numbers drastically. When you calculate cash on cash return on 20% versus cash on cash return on 10%, it's a lot easier to get a bigger return on that 10% of your dollars and keep the rest of that powder dry for putting that property together. And so this is not true. This is what people believed back in the day. Now, what 20% does get you is it allows you to not have something called PMI, or private mortgage insurance, on your loan, which is an extra fee that you pay on your loan. Anytime you put down less than 20%, you automatically have PMI put on that loan. And that is to kind of protect the lender, and you're paying it toward an insurance in case you default on the property. Once you hit 20% ownership, or you've paid down 20% of the loan, or some combination of the two, that PMI will drop off. Or if you put down 20%, you won't have PMI to begin with. And per this fact, 80% of first-time home buyers put down less than 20% and they succeed. FHA loans, seller financing, creative structures can dramatically lower the barrier to entry, and you don't have to wait and save a massive down payment. In fact, I'd encourage you to get started as soon as possible so you can start learning and start building equity. Real estate is a get rich quick play. This is definitely not true, right? This is one of the biggest myths. We work with a lot of investors here with the Ekabo home team. And one of the things we come across is there's people that say they're long-term investors, but in practice, they're actually more short-term in thinking. They're thinking about the run-up in 2021, 2022, and they're like, man, so if I buy in this neighborhood, what is my appreciation going to be next year and the year after that? That's what they're thinking. Or, hey, if I buy this right now, what's the cash flow today? And I'm not even looking at, down the road. when you're looking at real estate, this is absolutely not a get rich quick scheme. The best deals that you buy are going to be the ones that you have, for 5, 6, 7 years that start to just make sense across the board, right? For example, I bought this fourplex in 2023 in Snellville, and I've talked about it a lot. This is in Gwinnett County. And what happened when I purchased it is I bought it for about 800K. And at the time, it was only bringing in $6,000 per month, right? Now that was okay because when I looked at it, the median rent was $2,000 per unit, which means it should be bringing in 8 grand a month, right? Almost 1%. But the previous owners had bought it over a decade ago. They bought it for like 150. They did not feel the need to raise the rent. They were making plenty and they had the same tenants in there. And so when I came in, I came with a game plan, raised the rents, kicked out some tenants, updated some units, raised those rents. And when it sits today, we're actually bringing in closer to $9,000 per month, right, on that same deal. And now people are asking, hey, how'd you get that? Well, I didn't. I found a deal that was close and I turned it into something that was much, much more. And so this is a long-term play. You need to have a game plan and hang on to that property for a long term. Myth number 4, you have to time the market perfectly. I remember way back when in 2016 when I got started, a lot of people on different podcasts and shows saying, hey, we're heading toward another crash. The market's heating up. And then 2017, the market's heating up. We're heading toward another one. 2018, 2019, definitely 2020. And then it accelerated like crazy all the way through 22. Right now, we're sitting at a time where it is one of the best buying opportunities that we have had in the better part of a decade. There's literally stress in the market. Sellers are starting to come to terms with the fact that, hey, I'm not going to get that top dollar that I'm asking for. I missed the boat on that 2021, 2022, 3% or 2% interest rate. And so they're starting to be able to play ball a little bit more. And so coming back to this myth, you do not need to time the market perfectly. You just need to get into the game and buy a deal that works at that time, right? If you can buy a deal that works in today's environment, then when interest rates come down at some point and you refinance, it's going to be even better, right? When you had the low interest rate environment, a deal looked different. Back in 2020 and 2021, I was willing to pay 20, 30K over asking, right? To just lock in that deal because money was essentially free. I'm like, dude, I will do that, right? Let me just get this deal as much as I can. Right now, what we're doing is we're going to those sellers and we're negotiating hard. We're getting price reductions. We're getting credits that they're paying for to see if we can't make that deal sweeter and make sure that the numbers pencil. And as long as it pencils, it doesn't matter what environment you're buying in. And that's why I love being in the investment game because nobody can predict what's going to go, right? A few weeks ago, the interest rates were on the low. They were starting to come down. We finally hit 5.9 and it's been like 2.5, 3 years before we were at that point. And then we start this war and now we're back above 6. And so long story short, we can't predict what's going to happen, but we can pencil the numbers with the current environment. And if those numbers pencil, the good thing about the US of A is we have 30-year fixed loans. And so it'll continue to pencil for as long as you hold it. Past appreciation predicts future growth. This is not true. There's a caveat to this, right? There's definitely some zip codes in different areas where you can see like, man, this has been one of the best places to buy over time and there's strong economics there, but that does not necessarily mean that the future of that zip code is going to be up and to the right as well. The pieces that help determine that is what are the major draws there and what are the major constraints there. For example, when you look at the Metro of Atlanta, right, there's certain neighborhoods like the Alpharettas of the world, the East Cobbs of the world, the North Decaturs of the world, where you're in the better school districts and there's a lack of housing and people want to go and live in those school districts and they're willing to pay a pretty penny to be over there. When you look at the Atlanta Beltline, which is getting finished up before the World Cup, there's only so many houses that you can fit along that Beltline. And so people want to be there because you can walk, jog, bike. And so if you're able to get a property that makes sense over there, it's probably going to go up over time because now people have to go and barter with you to get a property on the Beltline and the others that are there that are not selling. And so you want to look for the constraints in a market and look for the major draws in certain portions of the market. And that's what's going to help you understand if it's going to go up to the right. And for example, when I was moving from the Northeast to the Southeast, I moved into a director role at the company that I was with before I moved into full-time real estate. And they told me I could choose to live anywhere in the Southeast. I purposely chose Atlanta over the Carolinas and over Florida. I'm thankful I didn't choose Florida because insurance rates, because Atlanta has 37 of the Fortune 1000 companies based here. And over the next decade, it just has such a diversity of employment and such a diversity of just positive factors coming in and different events and all that stuff that it just made sense for me to be here. And I'm happy with the decision. I've seen the fruits of those pay off. Now we are midway through the myths. We have 5 more myths we're going to debunk, but I'd I'd be remiss if I didn't say anybody that's in on the line, feel free to ask questions in the chat. We will get to it at the end. And feel free to ask any myth questions that you have. We're happy to answer it. I am Niyi Adewole with the Ekabo Home Team, Investor Friendly Realtors, based out of Atlanta, Georgia. We also cover Dallas and Florida. Moving on to number 6. Fix and flip is easy money. I meet with a lot of new investors on a day-to-day, and we usually have like a 15-minute discovery call. And I can't tell you how many people that I personally take time to walk them off the ledge because they're getting into their first investment and like, hey, I want to go do a fix and flip, property and go make X amount and kind of get off to the races and build my capital there. And this is where people get in trouble thinking that real estate is just, quick money. It's really a long-term game. I didn't attempt my first flip until I was 5 years in the game and had 30 units built up of long-term rental properties. And I would advise that you don't go for a flip on your first deal. Now, here goes the reasoning. When you learn to ride a bike, right, you typically start off on a tricycle or one of those bikes now where kids can kind of put their feet on the ground and pedal themselves. Then you graduate to like a tricycle. Then you graduate to a bike with training wheels. Then you graduate to a bike, and then you're off to the races, right? When you look at real estate investing, the tricycle example would be getting a house hack, going and buying somewhere that you're going to live in a portion of that house or that triplex or duplex or quadplex and rent the others out to help cover a portion of your mortgage or all of it. That is like learning with training wheels. It's really hard to mess that up. And even if you do, you had to have somewhere to live anyway, and you're probably living for a lot less than it would cost you to go and buy an apartment and things of that nature. So that's one. I would say that going and buying conventionally, where you're putting down 20% instead of that 5% or 3.5% on a house hack, would be like riding the regular bicycle, right? Like, hey, I don't need the training wheels. I'm just going to ride this bicycle because you have more money into it. So you really want to make sure that you're getting the right property. And I would say the fix and flip is a motorcycle without a helmet. Right? This is literally where you could make a lot of money or it could end tragically. And you could lose a lot of money very quickly because of contractors, even understanding how to manage those pieces. And the crazy thing is, like, we will help you with this, right? We will give you contractors and we will give you the agreements that we utilize and all the things. But when it comes to fix and flips, one of the things that's hurt people over the past few years is the Joanna Gaines of the world and the, Property Brothers, where they make flipping look easy. And all you see is the numbers on the TV and you're like, this is great. You don't realize that's like a 6, to 8 month span of just dollars getting spent out, chasing down contractors. Hey, this pipe burst. Now there's an overrun on cost. Are we going to make money on this? And a lot of those deals, especially for people that are doing it as new investors, do not make money. And so I'd highly recommend, right, that if you are brand new to investing, don't have a team built out yet, that you pick one of the other strategies to start out with, because what that's going to allow you to do is almost learn with training wheels, right? Start to build relationship with contractors, maintenance people, start to meet people, vet the people that we're going to give to you, right? And then you're able to go out and confidently do that first flip. Myth number 7, you need perfect credit to get into real estate investing. This is not true, okay? Now, good credit helps. It's going to help you get a better interest rate. It's going to help you potentially get a lower down payment, but you don't actually need perfect credit to get into real estate investing. There's certain lenders, right, and certain programs like FHA program where you could be in, as low as 600 and maybe even into the upper 500s and still get a loan. And there's certain types of programs where you're buying a pure investment with like a DSCR loan where you are able to get it based on the asset, and then they just need another partner to come in and have that credit piece. You also can get a cosigner to help you with that credit piece if you're the one bringing the money or whatever deal that you work out with the partner. And so you do not need perfect credit to go and buy a house. I think it's helpful. And I think it's helpful to have all your dollars and cents kind of in order before you start getting into real estate investing. Like you should, not have, hundreds of thousands of dollars of credit cards racked up when you get into real estate investing. You want to have that cleared and kind of focus on this piece, but you do not need perfect credit. That is a myth. You have to invest in your local market. This is completely untrue. We help investors, and I'm just going to rattle off a couple of places that we've helped investors from. We've helped investors from Japan. We had a couple that was stationed in Japan, and we helped them buy a short-term rental in Georgia, and then the next year buy a duplex out in Florida because they're building up their portfolio even while they're abroad and on base. We've helped plenty of investors out of California, New York, Chicago, Denver, Utah, and many other places around the country. We've helped in Hawaii. We've helped investors get investment property out in Georgia, because what matters is getting the right market and then having the right team. I personally was an investor in Louisville, Kentucky as my first market. Now I lived there for, about 15 months, and that's where I got my first house hack. But then I moved away to Boston when I got promoted, and I was in Boston for like 3.5 years. But that whole time, I was still funneling money back down to Louisville to buy more properties because I had an investor-friendly realtor, because I had built out my team from that, and I just felt comfortable continuing to invest. And so you need to invest where it makes sense, and especially in today's day and age where we have all the technology in the world, and you can have the boots on the ground with an investor-friendly realtor team. You're good to invest wherever. But what I would encourage you to do is not have 15 markets that you're looking at actively. You need to pick one market, right? Take your time, pick one market, and focus on that market so that you can become an expert. I got to a point when I was investing in Louisville, when we were running up to the 30 units, where if I saw a deal pop up, I knew immediately if I wanted to off run it, right? And exactly where it was located. Because I just kept seeing all the deals come through and kept running the numbers. Okay, hey, this is a deal. I want that one, right? Same thing that I'm developed here in Atlanta, especially with our team. We now can see when a property pops up, like, hey, that's a deal that we want to go after immediately. And we send it to our clients. And we can see others where we're like, nah, that one's probably not going to sell. Let's let that one sit for a bit and come back to it. So you don't need to invest in your local market. I would recommend, if the economics work in your local market, to go ahead and do it. It's going to de-risk a little bit for you, like mentally, because you're going to be able to drive by the house. But in today's day and age, you do not need to invest in your local. Pay off the mortgage as soon as possible. When it comes to other debts that you have, right? Whether it be credit card debt, I'm not going to say school debt because that's a little bit weird, right? And it has lower interest rate. But when it comes to credit card debt or loans that you may have to other people, you want to pay those off as quickly as you can, right? Credit card debt is a beast. Like that thing is taking, 25% interest on a monthly basis, and they're just continuing to make money off of you. And so those you want to knock out. But a mortgage, especially when you look at this compared to other vehicles, you're only paying, 6 to 8%, somewhere between there right now. And before it was even lower than that. And so this is one of the lowest fixed rates that you can have. And if you're running the numbers right, the tenants should be the ones paying that whole mortgage off for you. And so ideally, you should just be saving your money for the next investment, allowing the tenants to cover this investment, and then being able to go get some more property that's going to help you continue to build your wealth. And so I told you at the beginning about that triplex that I first bought, right? Where I lived in one unit, rented the other 3 out. I had $5,000 to my name at the time because I was new into the corporate, and I put that down on that property, right? Now, I started making more money when I moved up to Boston, and I had funds that I could have used to pay that whole thing off. But if I had done that, then that would be the only property that I had. What I did instead is I used those funds to invest in other properties. And on that triplex, I bought it for $190K. I put $5,000 down, never paid the mortgage myself. And when I ended up selling it 4 years later to move into bigger projects, it was worth $310,000, and I had only put $5,000 down. And so if you're doing the math on that, I can't do it that quickly, but $5,000 to, $110,000 that I walked away at that closing table with is a heck of a lot of a delta. And so if somebody can do the math for me and go ahead and throw that into the questions or into the chat, that'd be awesome. I'd love to give the percentage return that is, but that's possible with real estate, and it's possible because you're able to leverage the debt from the banks. Real estate debt is not the same as credit card debt. It's not the same as a loan shark debt or any of those other things that you should pay off quickly. And the final myth number 10, and I'm happy to answer any Q&As that you guys are throwing in there, so feel free to go ahead and throw those things in, is real estate is too risky and it is not liquid enough. Real estate is one of the best hedges for inflation, right? You're getting a fixed rate loan over 30 years. You can't get that in any other country that I'm aware of. And if there is another country, somebody let me know because I'll start buying there too. Most countries, you have to put down 30%, or if it's a more developing country, they want to see 50% now and 50% before they hand the keys over to you. So you're paying for the whole thing up front, right? In the US, because the way our government is structured and the way that the dollar is utilized around the world and how strong it is, we're able to get these low interest rate debts where our interest rate right now is like 6.5% for a personal home buyer, 6.3%, and you can get that for 30 years. Right? There's no other product that you can get 30-year fixed debt on that I'm aware of and be able to have that property continue to appreciate for you over that time period. And so when you look at real estate being too risky, if you look at any 5 to 10 year stretch, it's actually been up, right? Any 5 to 10 year stretch of holding onto a property, hey, I bought it on X date and this is the date that I'm actually going to liquidate, it's pretty much guaranteed to be up, which is amazing. And I've looked at that for all the properties that I purchased, and it's encouraged me to continue buying in a kind of of a weird environment that we're in right now. And then when you talk about not being liquid enough, there's many ways that you can leverage your property. One of the ways that I used property that I purchased in 2020 that I still have right now, or in 2021 that I still have right now, because I didn't want to sell the property itself. I have a renter in there and they're paying the mortgage and a bit more. And I got a HELOC on that property. And a HELOC is a home equity line of credit. If I were to go and get a credit card, the interest rate is going to be like 25%, right? The HELOC fluctuate with the Fed rate, but it sits around like 8%, we'll call it. And I'm able to pull on that anytime and use it for other investments. And so I personally use that HELOC to invest in flip deals, right? Where I know like, hey, 6 months, 8 months, we're going to get that house sold and then I get that money back to reinvest somewhere else. And then I take that delta and I use that to go buy long-term rentals that I can hang on to for a long, long time. Not to mention with real estate, you could do something that's so incredible, right? When that home starts to appreciate and it gets to a certain point, you can refinance and do something called a cash out refi. And what that essentially allows you to do is take on more debt on that property because your rent should be increasing over time. You get cash out of that property and you do not pay taxes on the cash that you just pulled out of that property because the government looks at that as, hey, it's really a loan. You're really taking debt. And so it's not like you earning income, but that's income that you have in your pocket today that you can spend on whatever it is that you want to spend it on. And the bonus one, the last one I'll give you as a bonus is that real estate is only for a select few. This is the biggest myth of all. Real estate is for everyone. I think that each and every one of us, especially with what's coming down the pike with AI and its ability to replace people's jobs, we need to own some of these stocks that are going to be going up. And we need to own real estate where people need to lay their head or businesses need to have their companies, right? Because these are going to be the pieces that stay. When you look at all the disruptions that we've had over the last, 300 years, real estate has always been one that has stayed. Why? Because people need to lay their head somewhere at night. And so if you can get ahead of that and run numbers and find deals that make sense, you're going to be well positioned to accelerate through this AI phase. And so I appreciate you guys joining as everybody is doing good and this answered all the questions. I appreciate you guys joining. Again, my name is Niyi Adewole with the Ekabo home team. We are investor-friendly realtors based out of Atlanta, Georgia, also covering Florida and Texas. And so we're happy to help you or answer any questions that you may have about real estate investing. And I look forward to seeing you guys in the future. Thank you.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence.